Hello and welcome to our August investment update. Markets have been on a remarkable journey since the April lows. Equity prices have rebounded sharply and many clients have asked, has the recovery been too fast, too much? It's a fair question, but as we'll explore today, the rally has been driven by solid fundamentals. Now sure, there's some froth appearing in the valuations of riskier stocks underpinned by low quality cash flows, but investing in them runs contrary to our investment philosophy at Rathbones. Risks of another pullback do remain, but the process behind your portfolios is designed to navigate them with discipline, with resilience. We'll also unpack the latest developments in US trade policy and what they mean for inflation and growth. I'll explain why we continue to hold US equities, but with a strong emphasis on diversification across regions. We'll end with a look at UK debt, which is a frequently asked topic at the moment. So has the equity recovery been too fast? The market bottomed on the 8th of April, and in the 3 months since, the S&P 500 rallied over 25%. That's a move that ranks in the top 1% of 3-month returns over the past half century. Now that's raised some eyebrows, but context matters. In the video I recorded in early April, I emphasised that equity market recoveries can be very quick if there aren't signs of bank stress, broader debt market stress, or highly elevated risks of an economic or profit recession. I set out why we didn't see those stresses, and so it follows that we don't think the recovery has been at odds with that backdrop, with the context. What's more, this rally hasn't been built on speculative excess. Institutional investors' positioning remains cautious, hedge fund re-risking has been modest, and long-only investors' equity exposure is still below where it usually is. Retail investors have played a larger role. That's nothing new. Retail flows as a percent of the size of the stock market have tripled since 2021 compared to the late 2010s. Now, retail money does tend to jump on bandwagons. It tends to follow trends, and there's evidence it makes the market more vulnerable to a larger reversal if a correction occurs, but it doesn't raise the risk of a correction per se. Statistically, the pace of gains makes a short-term pullback more likely, but short-term reversals are notoriously hard to trade. The transaction costs are usually too steep, and as fabled investor Peter Lynch once said, far more money has been lost by investors trying to anticipate corrections than has been lost in corrections themselves. At Rathbones, we focus on the longer term, where earnings growth, not market timing, drives returns. The bar for earnings growth this year isn't demanding. Analysts are leaving room for positive surprises. The key risk to the US market is a reversal in the incredible expansion of return on equity, a measure of profitability, of the technology giants that dominate the market. In other words, that the enormous amount of capital they are investing in the AI theme doesn't deliver the required returns. Now, we've done a lot of work analysing over many decades the performance of stocks greatly extending capital expenditure relative to their sales, the so-called investment risk factor. It's a reason to limit, but not to avoid exposure to these market colossi. So let's turn to US tariffs, or import taxes, which is a more pellucid description of them, right? Because sharper than expected inflation or a weaker than expected economy could arrest the market's bull run. China's terms are still evolving, but the effective tariff rate on US imports has surged from just over 2% at the start of the year to somewhere between 16 and 19%. Now that is a seismic shift. Tariff revenue in the second quarter alone exceeded the total collected in all of 2024. Now, the inflation impact was always going to take time. We expect a meaningful spike in September or October as pre-tariff stockpiles run down. Already, US manufacturers are reporting increased input prices, and consumer goods inflation is ticking up. This reinforces our decision to keep bond duration short, which you will have heard me talk about many times. Inflation risks are elevated, and the Federal Reserve is likely to prioritize price stability over growth. On the growth side, tariffs will weigh on real incomes and corporate profits. Real consumer expenditure has already been falling since December 24, but it's not likely to reach recessionary levels in our opinion. The one big beautiful bill, which includes major tax cuts and investment incentives, will likely prevent a destabilizing slide. Of course, high and rising government debt raises longer-term inflation risks, and it's another reason we favour shorter maturity bonds, much less exposed to this inflation risk and to concerns about higher government bond issuance. There are some weak spots in the growth data if you go looking for them. In June and July, America's Bureau of Labor Statistics its payroll diffusion index for the private sector fell below 50. That means more sectors were shedding jobs than adding to them. That's a rarity outside of a recession. But as I said, the weak spots are there if you go looking for them. Taking a more rounded view, the evidence points to slowing growth, but not recessionary levels. That's a hugely important distinction. Corporate earnings momentum has turned a corner too, and that's really positive. We continue to hold US equities. It's our largest single country allocation. The US remains home to the world's most profitable companies with strong balance sheets and high returns on capital, which is what we're looking for first and foremost in our equity selection. We rarely look for any particular geographic exposure as a first step. But valuations are rich in the US compared to elsewhere, even when we adjust for the fundamental reasons why one market should be more or less expensive than another. And there's that risk of compressing profitability among the technology giants I mentioned a moment ago. That's why diversification is key. We've been increasing exposure to European equities all year, where economic data has been beating expectations. The EU's coordinated fiscal expansion makes the US look less exceptional on this count. That's happening without the same inflation and debt concerns too. Share buybacks have now increased to US levels. Valuations are more attractive, of course, but valuation gaps only tend to matter at extremes or relative earnings, or when relative earnings growth starts to change significantly. And the valuation gap is unusually wide, adjusting for the different industry types. The price to earnings ratio in Europe is 25% below that of the US versus a norm of about 7%. Since 2021, the valuation gap has widened despite the difference between US and European profitability narrowing. This makes European equities a good diversifier for one of our key risks. We also see compelling opportunities in Japan. In fact, I'm going to make a note to speak more about Japan in my next video. And as we've discussed in recent videos, we like the UK market. In short, we're globally diversified. We don't follow global index weightings blindly. We allocate based on opportunity, risk, and uncertainty. And right now, that means a more balanced approach. To finish, let's return closer to home, because lots of clients are asking about UK government debt, the UK fiscal outlook. We're going to put out a note on this closer to the autumn budget, but a key point for global bond investors, and it's global investors that own the largest chunk of debt after the Bank of England, right? Fiscal challenges are by no means unique to the UK. Globally, fiscal discipline has weakened, while aging populations and geopolitical risks are driving up spending all over the world. The US and France face much worse debt trajectories than the UK. Japan has sustained high debt for decades without derailing per capita growth. The Chancellor has some tough choices, some partly of our own making, but we don't see an imminent crisis. So do look out for that note when it's published. But again, it's a reason for us to stay in shorter maturity gilts, less sensitive to fiscal concerns. Stubborn UK inflation is another reason, although we'll be reviewing our position on the inflation outlook over the course of this month. We've been highlighting the upside risk to UK inflation for over a year now, and we expect CPI inflation to stay between 3.5% and 4% for the rest of 2025. But there are more disinflationary forces in the pipeline. I'll update you on our findings next time. So where does this leave us? We're not chasing rallies, but we won't be panicking in pullbacks. We're managing risk actively and investing with discipline. The world is uncertain, but that's always been true. Over the past decade, we've navigated trade wars, pandemics, energy shocks, and inflation. And through it all, markets have rewarded patience, diversification, and a clear process. That's what we offer. That's investing well. I'm Edward Smith, Co-Chief Investment Officer at Rathbones Investment Management. I'll see you at the next update.